In this video, I'm going to give you the 5 steps you need to take to become a profitable trader in 90 days. Yes, guys, seriously. This is the video you wish you had when you first discovered trading. Let's dive in. Step 1. Get your technology and broker right. I cannot tell you the amount of times traders have said to me the only reason a trade got away from them was because a platform froze or the broker slipped them for a few pips or ticks. Poor technology will be the death of you. Don't be a victim. Not all brokers are equal. The ease of starting a brokerage these days means you will find so many nefarious actors all offering you direct market access and smooth execution. But really, it's just one guy in his bedroom with an offshore license and itchy fingers for your money. A good broker would have a good track record, international reputation, and the best technology. I see today many CFD brokers still using just MT4 and MT5 when options like Sierra Charts and CTrader exist. I'll let you be the judge after looking at the advantages these platforms give you as a trader. Go with a broker that will give you the best environment to succeed. Step 2. Learn everything about your technology. It's very common for most people to open a trading platform, look for the buy and sell button, and then start trading. I have horror stories of people buying 1,000 barrels of oil when they meant to buy 1,000 barrels. Some traders had no idea how to take partial profits on a simple platform like MT4. This not only limits the level of trade management you can engage in, it also limits your ability to react quickly and confidently. Every platform has a manual. Read it. You will be surprised as to what lies beneath. The first 2 steps should take you 30 days, no more. Let's recap. In step 1, we want a good broker with a good international reputation that offers good platforms. Mobile apps don't equal good broker. It's down to the technology. Let's face it, if all you do is trade on your phone, then you are heading to the poorhouse. Next, learn how to use your platform thoroughly. If there is anything in there that you can turn into an edge, you want to know about it, from shortcut key configuration to special tools like Market Profile. Step 3. Don't just learn the basics, learn what makes markets move. Years and man-hours are put into technical analysis with the misconception that the better your ability to analyze charts, the more successful you will become as a trader. Well, I guess that's why the failure rate is 90%. There is no correlation between hours spent studying charts and successful trading. Don't waste time you can't get back. All market moves come from ideas. Ideas lead to positions, positions lead to conviction, conviction leads to squeezes and capitulation. This is what trading is. In 2008, a few traders had an idea. This led to a speculative position to be taken in the credit default swap market. The owners of these positions had counterparties, the banks. Conviction meant both parties are going to hold on, but one will be wrong. Eventually, the counterparty risk was so high that one party had to fold. This is the squeeze. Winner takes all. If ideas make markets move and traders are always being squeezed, then your only job is to find the idea and where traders will capitulate. Learning this is easier than you think. This is how most professionals see this step. First, you find the idea. Let's use a current one. The UK economy is heading for a recession. This means currency devaluation. Assume the market knows this. The pound should have a downward trend visible on any price chart or market profile chart. If this is not the case, then the pound will be up. It is no longer possible for you to get short and expect a reasonable gain if the market is already short. So you now need to know at what point are the unfortunate convicted buyers going to bail. This is your opportunity to buy what they are selling. Take at least a month to visualize this on a single asset. I prefer cable as an option. The British pound. Step 4. Learn to position size. You are never going to have a perfect entry. Too much time is wasted on perfection. Accept that you are going to buy and sell early. This is normal. Don't waste time trying to overthink this. Instead, focus on the max potential downside and size accordingly. Here's an example. If you have $1,000 to risk on a trade and you know the asset is very volatile, it makes no sense for you to open a 10-lot Forex position or a 1-lot oil position. Instead, size into a standard lot, for example, on a day trade. This not only allows you to be marginally off on entry, but it also allows you to access if your position will get you back to break even. Let's look at a more practical example. The pound is at 125 and has dropped 100 pips in the US session. You buy at 124, You're looking to cash out back to 125. However, the pound drops another 50 pips to 123.50. It starts rebounding. You may have to consider getting out at 124.50. That's because someone else has paid 50 pips cheaper than you. They are likely to sell before you. So you overpaid, deal with it, and hope for better next time. In real terms, you still made $500. Considering your drawdown was only $500, this is only half of what you were prepared to lose. This is what risk management actually looks like. Don't be the guy who wastes 10 years trying to get a 1 to 3 absolute risk to reward. This is the path to over-leverage and failure. You should be 60 days in your trading journey at this point. I am fairly positive you will have a profitable demo account if you have followed Step 4 to the letter. Step 5. Fund a live account with no more than $500. This is where things get interesting. If you have made it this far, I will drop a nugget at the end. Funding a live account with a small amount of money takes any emotional edge off. In fact, you could even fund your account with less than this. Remember, you just traded a demo account profitably. Set some goals and stick to the basic plan in Step 4. Don't overcomplicate things. The goal is to be profitable after 30 days of live trading, not to become a millionaire. Goals should be simple and achievable. Remember, $500 is a fraction of your net worth. You should have no issue risking 50% of it on proper sizing with enough wiggle room. What do I mean? $250 divided by 100 pips equals $2.50 per pip. This is your size. This is 1/4 of a lot. This means you'll likely make at best $125 to $250 if you are right, and technically lose the whole thing if you are very wrong, and you need to be very wrong. This is what we mean by high probability trade outcomes. Do you think the big money are using 1% risk on account? How then did they need a bailout in 2008? Or how come we hear that a billion-dollar fund gets margin called? Well, it's because the big money knows sometimes you need to be able to hold on with an eventual capitulation point or stop loss. See where you are at the end of 30 days. Either you will have a profit or you would have lost all your $500. Now wait, there is more. If you have lost your $500, then you need to increase your volatility adjusted risk parameters to say 200 pips. This will cut down your position by half. You will at some point find your market's sweet spot or capitulation levels. You can now deposit another $500 and start again. Your max loss should not exceed $2,000. If you have followed all the above steps, you will not come near to the max loss. There are many people out there teaching trading, all claiming to be successful. How do you know for sure how they trade? This is the quickest way to become profitable and level up in 90 days. For more videos on becoming profitable, click the subscribe button.